Here is a fact that most Canadians will push back on immediately. A research analysis by Ben Felix and Hamza bin Arig, published in a 2025 update using historical Canadian housing data from 2005 to 2024, found that a renter who consistently invested the difference between owning and renting costs in Toronto ended up with 37% more wealth than a homeowner over a 20-year period. Not 5% more, not 10% more, 37% more wealth. From renting. Now, before you close this video, here's what's equally true. In Vancouver over that same period, the homeowner won. The buyer ended up with 12% more wealth than the renter-investor. Same country, same time period. Completely opposite outcomes, depending purely on the city and the math behind the decision. This is the most important personal finance topic in Canada right now, and it is almost universally discussed wrong. People on both sides argue from emotion, from identity, from what their parents told them, from what their friends are doing. The data doesn't care about any of that. The national average home price in Canada, as of March 2026, is $673,084, down 0.8% year-over-year, according to CREA. Average monthly rent across Canada has fallen to $2,008, an 18-month low, down 5.3% year-over-year, according to the National Rental Report for March 2026. In this environment, with prices where they are and rents where they are, the buy versus rent decision is more mathematically nuanced than at any point in the last decade. And in this video, we're going to break down every number you need to make it correctly. Let's start with the statement most Canadians have heard their entire lives. Renting is just throwing money away. It sounds logical. You pay rent every month and you own nothing at the end. You pay a mortgage and you build equity. Simple. Except the math behind that statement is almost completely wrong. And believing it without running the numbers has cost millions of Canadians hundreds of thousands of dollars in suboptimal decisions. Here's what homeowners are actually throwing away every single month. Mortgage interest. In the early years of a Canadian mortgage, the majority of each payment goes to interest, not equity. On a $600,000 mortgage at 4.14%, the lowest 5-year fixed rate available in Canada, as of May 16, 2026, according to Nesto. A standard monthly payment over 25 years is approximately $3,196 per month. In year one, approximately $2,067 of that $3,196 goes to interest. Only $1,129 builds equity. The renter, throwing away $2,008 in rent, is paying less in non-equity costs than the homeowner, who is throwing away $2,067 in interest alone, before taxes, before maintenance, before insurance. Property taxes. In Toronto, the 2026 property tax rate on an average home is approximately 0.70%. On a $700,000 property, that's $4,900 per year or $408 per month. In smaller Ontario cities, the rate often exceeds 1%. Mississauga, Hamilton, and others are regularly above $6,000 to $8,000 annually on comparable properties. Maintenance. CMHC recommends budgeting 1% to 3% of your home's value per year for maintenance. A Zillow and Thumbtack analysis published November 2025 found the average hidden costs of home ownership, insurance, maintenance, and property tax add up to $15,979 per year in North America. In Canada, CMHC's 1% to 3% rule on a $673,000 home means $6,730 to $20,190 per year just in maintenance reserves. CMHC insurance. If your down payment is under 20%, you pay CMHC mortgage default insurance. The premium is 2.8% to 4.0% of the mortgage amount, paid on top of your purchase. On a $600,000 mortgage with a 5% down payment, that's a $24,000 CMHC premium added to your mortgage. In Ontario, there's an additional 8% RST on that premium, another $1,920 payable at closing. Land transfer tax. In Ontario, the land transfer tax on a $673,000 home is approximately $10,950. Toronto buyers pay a second municipal land transfer tax, another $10,950. Combined for Toronto buyers, nearly $22,000 payable at closing before moving costs, legal fees, or home inspection. None of these costs build equity. All of them are thrown away, just quietly, in categories most homeowners never add up. Your action step. Before calling renting throwing money away, calculate your real monthly homeownership cost. Mortgage interest only, not principal, property tax, maintenance reserve, home insurance, and any condo fees. Compare that to your rent. The gap may surprise you. Let's build the complete picture of what buying a home in Canada actually costs in 2026. Not just the purchase price, not just the mortgage payment, but every dollar. For this exercise, we'll use $673,000, the national average home price. Scenario: $673,000 home, 10% down payment, 4.14% mortgage rate, 25-year amortization. Purchase price $673,000. Down payment 10%, $67,300. Mortgage amount $605,700. CMHC insurance premium 3.10%, $18,777. Total mortgage with CMHC $624,477. Monthly mortgage payment approximately $3,318 per month. Ontario land transfer tax approximately $9,350. Toronto Municipal LTT, if applicable, approximately $9,350. Legal fees plus title insurance approximately $2,000. Home inspection approximately $500. Moving costs approximately $1,500. Total upfront cash required approximately $90,000. And that's before you move in. The true ongoing monthly cost. Mortgage payment $3,318. Property tax. Toronto average approximately 0.70%. Approximately $393 per month. Home insurance approximately $150 per month. Maintenance reserve 1.5% annually, approximately $841 per month. Total monthly ownership cost approximately $4,702 per month. Compare that directly to the national average rent of $2,008 per month for March 2026, or approximately $2,200 for a one-bedroom in Toronto. The monthly gap between owning and renting in this scenario, approximately $2,500 to $2,700 per month. That gap, $2,500 to $2,700 per month, is the number this entire video is built around, because what you do with that gap determines everything. The National Home Buying Affordability Ratio reached 54% in 2024, up from 39% in 2019, according to CMHC. That means a family buying the average Canadian home at today's prices spends 54% of pre-tax household income on housing costs. The traditional threshold for financial stress is 30%. And according to the Parliamentary Budget Office, 2.4 million Canadian households were in core housing need as of 2024, meaning shelter costs exceed 30% of before-tax income with no affordable alternatives available. Your action step: calculate your own all-in monthly ownership cost for a home in your target market. Add mortgage payment, property tax, maintenance reserve, and insurance. Compare to your current rent. That monthly gap is your critical variable. Here is where the math gets genuinely interesting, and where the Toronto renter ending up with 37% more wealth than the homeowner stops being a surprise. The gap between renting and owning in a major Canadian market is approximately $2,500 to $2,700 per month in true all-in costs, based on the 2026 national average home price of $673,000 versus the national average rent of $2,008. Now, here's the critical question that almost nobody asks. What happens if the renter invests that $2,500 per month instead of spending it on homeownership costs? At 8% average annual return, the conservative long-run estimate for a low-cost S&P 500 ETF, here's what $2,500 per month produces inside a TFSA. All projections at 8% average annual return. Inside TFSA, 100% tax-free. $2.3 million in 25 years, tax-free, from the monthly cost difference alone. Now compare that to what the homeowner builds, starting with the $673,000 national average home price, assuming a conservative Canadian long-term appreciation rate of approximately 3% to 4% annually, which is the CREA 2026 forecast consensus, and accounting for all the costs of ownership paid over 25 years. Property value after 25 years at 3.5% annual appreciation, approximately $1,562,000. Total interest paid over 25 years on a $624,477 mortgage at 4.14%, approximately $454,000. Total property taxes over 25 years at 0.70% on growing value, approximately $105,000. Total maintenance over 25 years, 1.5% of growing home value, approximately $170,000. Closing costs paid up front, approximately $23,000. Net homeowner wealth position after 25 years, home worth $1,562,000 minus $624,477 remaining mortgage costs already paid, minus total non-equity costs of approximately $752,000 equals net equity position of approximately $810,000 to $860,000. The disciplined renter investing $2,500 per month over 25 years, $2,309,000, tax-free. That's not the renter winning in every scenario. That's the math of a specific set of assumptions. Change the appreciation rate, change the investment return, change the city, and the answer changes. But it completely destroys the idea that renting is financially inferior by default. The renter who actually invests the difference can build dramatically more wealth than the homeowner in many Canadian markets, particularly at today's prices and mortgage rates. The problem is the word actually. Most renters don't invest the difference. They spend it. And then the math flips completely. This is the most important sentence in this video. Renting only wins financially if you invest the difference consistently and without exception. Your action step: open a TFSA today if you don't have one. Whatever your monthly gap is between renting and what ownership would cost, automate that amount into a low-cost S&P 500 ETF every single month. That's the math that makes renting a genuine wealth-building strategy instead of just a housing choice. Everything we've covered so far makes the case for renting and investing in certain markets and at certain price levels. But this is not an anti-home ownership video. The math cuts both ways, and there are clear data-backed scenarios where buying genuinely wins. When buying makes financial sense. 1. When you plan to stay for 7 to 10 plus years. The break-even point, where the total cost of buying equals the total cost of renting, is typically 7 to 10 years in most Canadian markets at current prices and rates, according to the House Index 2026 Toronto Rent Vs Buy analysis. Before that point, the transaction costs of buying, land transfer tax, CMHC, legal fees, agent commissions on sale, haven't been amortized enough to make ownership financially superior. If you're staying in a city for 10 plus years and the market is stable, buying builds equity that compounds alongside appreciation. Forced savings through mortgage principal is a powerful wealth-building mechanism for people who would otherwise not invest the difference. 2. When you're in Vancouver, or markets with strong historical appreciation. As the Felix 2025 data showed, Vancouver homeowners outperformed renter investors by 12% over 20 years. In markets with sustained, strong price appreciation, the leverage of owning a physical asset with a large mortgage working in your favor can outperform investment returns. Calgary and Edmonton have also historically offered strong price-to-rent ratios that favor ownership for long-term holders. 3. When you're buying below the national average price, the math changes dramatically in smaller markets. In cities where homes are priced at $350,000 to $500,000, Winnipeg, Saskatoon, smaller Ontario cities, Nova Scotia outside Halifax, the monthly gap between renting and owning shrinks significantly. The down payment is achievable without gutting your investment portfolio, and the CMHC premium is a much smaller absolute number. 4. When the alternative is not investing anyway. This is the honest truth most people don't want to say. Mortgage payments are forced savings. Principal repayment builds equity automatically, whether you think about it or not. For Canadians who, without the structure of a mortgage, would simply spend the difference on lifestyle, buying is often the better financial outcome in practice, even if it's not the best outcome on a spreadsheet. 5. When the principal residence exemption matters. In Canada, profits from the sale of your principal residence are completely tax-free under the principal residence exemption. A homeowner who buys for $500,000 and sells 15 years later for $900,000 pays zero capital gains tax on that $400,000 profit. An investor who builds $400,000 in TFSA gains also pays zero. But a non-registered investor would owe capital gains tax on half that gain. The tax treatment of real estate appreciation is uniquely favorable in Canada, and it's a genuine advantage that tilts the math toward buying in long-term scenarios outside registered accounts. Here's the most useful analytical tool in the entire rent versus buy debate, and most Canadians have never heard of it. The price-to-rent ratio. It's simple. Take the purchase price of a home and divide it by the annual rent for a comparable property in the same area. Price-to-rent ratio equals home price divided by annual rent. Here's how to interpret the result. Below 15 strongly favors buying. 15 to 20 buying is reasonable with a long time horizon. 20 to 25 renting is likely more efficient financially. Above 25 renting strongly favored. Buying is expensive relative to rental income. Now let's apply it to actual 2026 Canadian markets. Toronto. Average home price approximately $1,070,000. CREA 2026. Divided by annual rent for comparable unit, approximately $28,800 per year, equals $2,400 per month, equals price-to-rent ratio, 37.2. Well above 25. Renting is strongly favored on a pure financial basis in Toronto at current prices. Vancouver. Average home price approximately $1,180,000 divided by annual rent, approximately $30,000, equals price-to-rent ratio, 39.3. Even higher than Toronto. The historical appreciation of Vancouver real estate is what justified this ratio for long-term holders. But on a pure current cash flow basis, renting is dramatically cheaper. Calgary. Average home price approximately $610,000 divided by annual rent approximately $24,000, $2,000 per month, equals price-to-rent ratio, 25.4. At the boundary. This is where the decision becomes genuinely close, and long-term intentions, local market knowledge, and personal factors dominate the math. Winnipeg. Average home price approximately $380,000 divided by annual rent approximately $18,000, $1,500 per month, equals price-to-rent ratio, 21.1. In the reasonable with long-time horizon zone, buying in Winnipeg at these ratios has historically been defensible, and the lower absolute prices make the down payment more achievable without sacrificing investment potential. National average, $673,000 divided by 2008 times 12 equals $24,096 per year, equals price-to-rent ratio, 27.9, above 25. At the national average price and national average rent, the data favors renting and investing on a pure financial basis, provided you actually invest the difference. The price-to-rent ratio doesn't make the decision for you, but it gives you a fact-based starting point instead of an emotional one. Your action step: calculate the price-to-rent ratio for your specific target market right now. Take the home price you're considering. Divide by the annual rent for a comparable unit in the same area. If the number is above 25, run the investment math before making the decision. You now have every data point you need. Here's how to put it together into a decision framework. Step 1. Calculate your price-to-rent ratio. Take the home you're considering. Divide the price by the annual rent for a comparable unit in the same neighborhood. If it's above 25, the investment math heavily favors renting. Below 15, buying is likely stronger. 15 to 25. Run the full comparison. Step 2. Calculate your true all-in monthly ownership cost. Mortgage payment plus property tax plus maintenance reserve, 1% to 3% of home value annually divided by 12, plus home insurance, plus condo fees if applicable. This is your real monthly cost of owning. Step 3. Calculate the monthly gap. Your all-in ownership cost minus your current rent equals the gap. If that gap is $2,500, That's $2,500 per month that either goes to home ownership costs or to your TFSA. Step 4. Run the investment math on the gap. $2,500 per month at 8% over 20 years equals $1,481,000 tax-free in your TFSA. Is the equity you'd build in the same home over 20 years, net of all costs, larger or smaller than that? In most major Canadian markets at a price-to-rent ratio above 25, the answer is smaller. Step 5. Be honest about your behavior. Will you actually invest the difference? Every single month, automatically, without touching it when markets drop? If the honest answer is no, home ownership as forced savings may genuinely serve you better than renting, even if the spreadsheet says otherwise. Step 6. Factor in your time horizon. Buying in a market with a ratio of 30 can still make sense if you're staying for 15 to 20-plus years. The appreciation and equity accumulation over long periods in stable Canadian markets has historically been positive. But if you might move in 3 to 5 years, the transaction costs of buying will likely eat any advantage entirely. Canada needs to build 430,000 to 480,000 homes annually by 2035 to restore 2019 affordability levels, according to CMHC, and only 259,000 units were started in 2025. The supply gap is not closing quickly. That structural undersupply is a legitimate long-term argument for owning in markets where you intend to stay, because prices are unlikely to fall dramatically while supply remains this constrained. Your action step. This week, whether you're a renter or considering buying, run all 6 steps for your specific situation. The numbers will tell you which path makes more sense for your market, your timeline, and your behavior. Let's come back to where we started. A Toronto renter who consistently invested the difference between renting and owning ended up with 37% more wealth than a homeowner over 20 years. A Vancouver renter investor trailed the homeowner by 12% over the same period. Same country, same time period, opposite outcomes. Here's what that tells you. This decision is not universal. It is not emotional. It is not about what your parents did, what your friends are doing, or what Canadian culture says you're supposed to want. It is a math problem with variables that are specific to your city, your timeline, your income, your behavior, and the current price-to-rent ratio of your market. The national average home price is $673,084, CREA, March 2026. The national average rent is $2,008 per month, an 18-month low. The national price-to-rent ratio is 27.9, above the threshold where renting and investing is financially favored on the numbers alone. But Canada also has a 430,000 to 480,000 annual housing supply gap, CMHC, with only 259,000 units started in 2025, meaning the structural case for long-term price appreciation in most Canadian markets remains intact. Both things are true, and both things belong in your decision. The homeownership debate in Canada has been polluted by emotion for decades. People who own feel validated by buying. People who rent feel defensive about not buying. Neither camp is using the actual math to make the case. Now you have the math. You have the price-to-rent ratio for your market. You have the true cost of ownership. You have the investment math for the monthly gap. You have the 6-step framework. The answer is different for every Canadian, based on their city, their timeline, and whether they'll actually invest the difference. Run your numbers. Make your decision from data. That's how you build wealth in Canada's housing market. regardless of which side of the door you're on.